moving from the US and to South Africa, on Friday, ICASA published the draft call termination regulations related to the fees that operators charge each other for terminating or connecting calls. The move imposes aggressive wholesale call price advantages for operators with less than a 20% market share. For a closer look at the impact, we have Dr. Christoph Stork. He's a senior researcher at Research ICT Africa, and he joins us now in our Cape Town studio. Christoph, thank you so much for joining us. Now, these cuts sound like good news for the consumer, but what does it mean for the industry?
Generally, the termination rate cuts will lead to more competition, and more competition will lead to lower prices for consumers. Cell C has already announced that they are planning an aggressive price strategy, and as soon as MTN and Vodacom would lose customers, they may also then reduce prices, leading to generally lower prices and an expansion of the market. So it will not just be a question of everyone having a SIM card and a mobile phone, but also of poorer people being able to use more data and more voice. So generally it will mean good news for everyone.
Allow me to play the devil's advocate for 2 seconds, Christoph. I mean, there is an argument that these lower termination rates are actually going to increase barriers for new entrants because existing operators are going to try and find other avenues of making up for the potentially lost revenue. How do you respond to this, and do you think that there's any merit in this argument?
Yeah, first of all, we have to look into what termination rates are or what revenue streams they are causing. And generally, it's a zero-sum game. So if their net payers pay less and the net receivers receive less, but no money is taken from the industry. So lower termination rates may mean that the net cash flow from termination from MTN or Vodacom may decline, but at the same time, also the net payment of Telkom and Cell C will decline. And therefore nothing is taken from the industry, so one would expect overall not a negative impact. And what we've seen from Vodacom and MTN is that both companies managed to retain the revenues, increase their subscriber base. Vodacom made more profits the last financial year, so they're both doing exceptionally well, despite having complained that the mobile termination rate cuts of the last 2 or 3 years would affect them negatively. But we don't see this in the end results. So I have no doubt that they will continue to be successful and that we wouldn't need to worry about what their business case is.
Of course,
they're both very innovative and competitive companies.
Of course, there's also another argument, Christoph, that says that these asymmetry rates are likely to see a promotion of investment into the industry. Talk us through a little bit about how that relationship unfolds.
As the asymmetry is usually a measure which would only be recommended for a short period of time, and it gives new entrants the opportunity that do not have many customers and therefore probably would receive less calls than being made from the network to generate revenue to fund their investment. The fact that termination rates were only reduced very late in South Africa, they should have been cost-based from 2001 when Cell C entered the market, has stifled market entry and had made it very difficult for Cell C to gain market share. In general, if a new operator comes into a country or starts operation, they have to compete with the larger networks. And if someone moves from the large network to the small network, the ratio of off-net to on-net minutes changes. First on a network maybe with 50% market share, one would expect 50% on-net and 50% off-net calls. But now if I move to, let's say, Telkom Mobile with maybe 5% market share, suddenly 95% of my calls are off-net. That means that the new entrant needs to compete with its off-net rates with the on-net rates of the bigger operators, which it can only do if there's cost-based termination rates, if their termination rates are low. Otherwise, it wouldn't be able to compete.
Of course,
the asymmetry just Sorry?
Of course, Christoph, if I may just interject there, the more dominant players, MTN and Vodacom, one would expect that their reaction to this proposal would be for them to challenge it. Should they challenge the proposal, do they have any scope to stop these proposed termination rates from going through?
I'm not a lawyer, I'm an economist, so I can't really answer this.
Okay, so let's perhaps move away from the legal aspect of the conversation and look at the broader conversation between voice and data. Do you think that this is a broader strategy of also increasing the declining trend that we've been seeing around voice in relatively to data numbers?
Yeah, we see there's a substitution of data for voice, and that MTN and Vodacom both have increased the data revenues over the last 2 or 3 years. So the declining revenues or profits from voice will, over the longer term, be compensated by a focus on data revenues and data profits. That's without a doubt.
Of course,
and there the termination rates don't have a direct impact.
Of course, Christoph, before I let you go, you also made the point that South Africa is a bit late in the game, and this is a shift that should have taken place as early as 2001. In light of that, how does South Africa compare to the rest of the continent?
So at the moment, South Africa is ranked in terms of prepaid prices between 23 and 20 and 30. Depending on the month and depending on whether one looks into dominant operators or just the cheapest in the country. And many countries, in particular Kenya and Namibia, are a whole lot cheaper than South Africa. And now with this new termination rate, one would expect the prices also to come down. Maybe by the time the termination rates have reached 10 cents, we can expect maybe 30 cents per minute prepaid call rates, similar to those rates in Ghana or in Kenya or Namibia.